We're going to calculate the stock price for Park Lawn. This is a Canadian company, and the first step is the market cap, 671.2 million. And then the stock price, 22.81. And now we know the shares outstanding because it's just a market cap divided by the stock price, 29 million shares outstanding. And we're going to estimate the future free cash flow of the company and discount that number back to today's value. And that number will be the value of the company. And we get that value, we divide it by the number of shares, 29 million, and we get an intrinsic value for the stock price. And we're going to compare it to the actual stock price to see if it's a buy or sell. Now we're going to get the actual free cash flow. We'll go to Yahoo Financials, cash flow, and then pull the free cash flow. There's one negative number in there, but everything else is positive. Net income is next. That's on the income statement, and that's the profit and loss for a given time period. And the last input for the model is revenue. A nice jump in revenue. Always look at the numbers when you're doing this stuff. You can see the revenue quadrupled from 2016 to 2019, although net income barely moved in that period. So that's a little concerning, but something we could look into later. Now we need to look at the capital structure of PLC and figure out the discount rate we need to apply to the future cash flows. So the interest expense is 5.4 million. That's the interest they pay on their debt. Now let's see how much debt they have. We'll go to the liabilities section of the balance sheet, and the current debt is 1.7 million. That's the debt due within 12 months. And long-term debt is 180 million. That's debt due beyond 1 year. So they pay 3% interest on the debt. But interest payments are tax deductible. So let's find out the effective tax rate. We'll go back to the income statement. Income before tax is 10 million. So it's a pretty small company. Income tax is 2.8 million. So the effective tax rate is 28%. So the cost of debt is 2.13%. And 21% of their capital structure is debt, which isn't too bad. Now let's get the cost of equity. We need their beta, which is 1.53. And now the cost of equity is 14%, and we do that by using a CAPM, capital asset pricing model. And when we merge these two numbers together, the cost of equity and cost of debt, we get the WACC, the weighted average cost of capital. And that's what we're going to use to discount the future cash flows. So we calculated 4 years of cash flows based off of our inputs earlier. And we calculate a terminal value. That's all the future values after year 4. And then we discounted those numbers back to today's values. And we come up with $536 million for the value of the company. And when we divide that by 29 million shares, we get a stock price of $18. It's trading at 23, so it's trading at a premium, a 25% premium. So let's look at the historical. So it was trading, it looks like around $30 a few months ago, and it's dropped down to 23. It looks like it was trading around 18, 19 in March, but it's come back up. So stocks can trade well above or below what they're actually worth. It's what people are willing to pay for the stock. And if more people want to buy the stock, the price gets bid up. And if more people want to sell the stock, it keeps getting pushed down the stock. So it's everybody's perception on a company, not reality, which a lot of people probably understand this from watching the market these past few months. So everyone has their own opinion on a stock, and this is my opinion. So thanks for watching.